the inaugural event in a new Stanford Brown investment series. For those of you who don't know me, my name is Vincent O'Neill and I am the CEO of Stanford Brown. Welcome, of course, to our many clients, but also to their friends and colleagues who may be joining one of our events for the first time this evening. Before we begin formal proceedings, importantly, an acknowledgement that today we are fortunate to gather on Gadigal land. And I would like to acknowledge the Gadigal people of the Eora Nation as the traditional owners of the land on which we meet. I pay respect to the elders past and present, and pay my respects to all the people here today. I would also like to thank Macquarie for their generosity in allowing us to use this beautiful venue to host you all this evening. I was commenting this a little bit like a Bond villain's lair as you come up that glass elevator and you go through that. I was like, I didn't mean to cast any dispersions on Macquarie when I described the Bond villain lair, but it is very impressive. In recent years, the landscape has changed for private clients, allowing them to access strategies and managers previously only available to institutional capital. This has opened an extensive universe to private wealth investors. Our aim in these events is to enhance the knowledge and understanding of you, our clients, by hosting these briefings. The sessions will offer detailed insights, allowing you to hear directly from asset managers operating within the space. Tonight we have scheduled a tale of two Andrews, but unfortunately Andrew Crutman has been called to an urgent family matter, so in his place, Macquarie have spared no effort in making available Brett Jolly, Division Director of Macquarie Asset Management. We will also be hearing from Andrew Lockhart, Managing Partner at Metrics Credit Partners. Now, Stanford Brown, beyond facilitating access to these strategies, we aim, in collaboration with our Inviter Investment Committee, that includes our institutional research partner, JAMA, to drive clients comprehensive advice and research on these assets. While gaining access to these investments might be straightforward, all managers and strategies are certainly not equal. And we are very much of the view that the last decade, and one of very low interest rates, was perhaps an easier environment to operate in. The next decade, with much higher interest rates, potentially lingering inflation, will be one where the top quartile of managers will be very much differentiated in their performance from the rest. We aim to bring to you best-in-class investment strategies, and the crucial task of discerning quality from mediocrity falls to the dedicated Stanford Brown Chief Investment Office. That office is led by our Chief Investment Officer, Nick Ryder. I'm pleased now to welcome Nick to the stage. Nick is an investment professional with deep and broad experience built up over 30 years in the investment management and financial service industries. Before joining Stanford Brown in early 2023, Nick was a senior investment strategist at Commonwealth Bank, and before that, JB Ware and NAB, providing strategies to wealthy individuals, families, and not-for-profit clients. I will flag that we intend to do Q&A at the end of tonight's session, so please ask, if you can, to not ask any questions during any of our three speakers, but we will offer you the opportunity to ask those questions at the end of today's session. Can you all please join me in welcoming to the stage Nick Ryder.
Thanks, Vincent. So as Vincent mentioned, we are pushing into private markets. We see it as a valuable source of additional returns for clients. And increasingly, we have seen the democratization of what were institutional investments. They've started to come down into private client space, particularly for wholesale investors. So how do we think about private markets at Stanford Brown? When I talk about private markets, I'm talking about private equity, private credit, which we have a speaker today, private infrastructure, which we also have another speaker today, private real estate, and other private asset classes where the securities are not traded and the assets are held for long periods of time. Big super funds like Post Plus, etc., have up to 30% of their portfolios in private markets, and they have the luxury of a young member base, and so they can invest for very long periods of time. But obviously, our clients don't necessarily fit into that category. And so when we think about private markets, we think about how do we position these within client portfolios. And it's another measure of, another dimension of advice. So when we talk to our clients, we talk to them about the risk they want, the income they want, the returns they're seeking. But I think the other thing that we should be asking clients is how much are you prepared to lock up in investments for longer periods of time and hopefully earn a better return than you would from investments that you can get out of tomorrow or next week. So private markets can potentially offer that. So how do we think about them? Well, some firms treat private markets as a separate asset class, but what we try and do is incorporate them in our asset allocation framework. So we have 8 asset classes at Standard Brown: Australian equities, global equities, property and real assets, Australian debt, global debt, alternative investments. And what we try and do is we map each of the private markets to the public ones. So we're treating private equity within equities, for example. Private credit goes into Australian debt or global debt. Private real estate and private infrastructure within property and real assets. Because what we've found is over time, the asset classes do have very much, so the private and public sort of converge. So there might be, you might have a drawdown, might be sort of in the GFC where public markets fall and the private markets might fall. But over time, you will find that the returns do tend to converge because ultimately they're the same drivers. Whether the property is listed on the stock exchange or held in a private fund, ultimately over a long period of time, it's rent and demand and things like that that drive returns. So that's how we think about it at Stanford Brown. Yeah, the other thing, and I think this is something to be aware of. Some firms do talk about private markets as sort of the panacea. These are great assets because they don't move in price. They're very stable valuations, and that's because the underlying assets are valued by a valuer. It's like a guy that comes to your house every quarter and says, "Oh, this is what I think your house is worth based on what other ones traded in the street." And so the prices tend to be pretty smooth, whereas obviously in public markets, prices can bounce around a lot. But as I said, ultimately over the long term, it's the same economic drivers. So for us, it's not just the low volatility or the lack of correlation with other asset classes. It's really about the returns. We hope that by locking our client money up for long periods of time, we're getting compensated for that. And the data suggests that, for example, with private equity, you're getting at least 5% per annum more than public equities. So, for example, in Australia, the Australian Private Equity Index, there is an index, did about 14% per annum over the last decade or 20 years, versus about 7% for public equity. So you're getting compensated for locking your money up for long periods of time by going private. And in private credit or private lending, it's maybe not 5% per annum, maybe it's 1 or 2% per annum. But we make sure that people are actually getting compensated for locking their money up. What we don't want is clients locking their money up and getting worse returns than what they would get from publicly traded securities. One of the other things that are attractive about the asset class, I think the other thing that's attractive about the asset class is in some of these, there's really good opportunities for the fund manager to add value that there isn't in public markets. So an Australian equity market manager can't influence CBA or BHP management, maybe a little bit by voting at meetings. But when an asset's held privately, there's greater opportunity for the manager to influence the performance, if it's private equity or real estate or infrastructure where they own the equity. Or with private credit, there's greater opportunity to have better insight into how the underlying business is performing, getting regular accounts. We have one manager that talks about legalised insider trading, in private markets. So that's often a way that they can add value. And they're often negotiating to buy these assets off market, not in an auction situation. It's like when you go to buy a house, you don't want to buy it necessarily in an auction. If you can buy it off market, that's value that's created. So that's another reason that we like these asset classes. So what are some of the issues? It's a very complex asset class. Sometimes the funds are what we call closed-end funds, where they launch a fund, they ask the investors to commit maybe $100,000, and they say, "I will tell you when we've found some investments, and then we'll ring you up or send you an email or whatever it is, and you have to send money within a couple of weeks to pay for that investment." So that's called a drawdown structure, and we do have some of those, but they're more complicated. If you're away and you miss the call, or If you fail to pay, there's big penalties. So they're difficult structures for some clients. Then often you have to keep the cash aside to meet those calls when they come. The other types of structures that we like are what we call evergreen structures. These are funds that are always open, and they're really designed for smaller clients to put money in and pull money out, subject to the fund manager not getting too much money that he can't invest, or getting too much money trying to go out at any one time. So they're called semi-liquid or best efforts liquidity structures. But the beauty of those is the smaller clients that you can sort of get in and sort of get out under normal sort of market conditions. Now, of course, if everyone's get out at the same time, it's not going to be possible. So that's one of the structures that we have, and the two funds that are here today are what we call these evergreen structures that allow smaller private clients, to come and go on a best efforts basis. So that ticks a lot of boxes for us. In terms of how we assess managers, we're looking for managers that have a very strong franchise or platform. In the case of Macquarie, they were one of the pioneers, for example, in infrastructure investing in the mid-1990s. So they have a very strong pedigree and platform in being able to assess infrastructure investments, not just in Australia, but around the world. So that's the sort of manager that we're looking for, that have a competitive advantage when it comes to that asset class. And the same with metrics, and I'm sure they'll talk about their backgrounds. The competitive advantage, how are they going to be able to make money for us in the future? And also, when you're locking your money up for 10 years in some of these structures, you want to really make sure that you're investing with people that are going to be around, that are aligned to investors, and that have a competitive advantage. So there's some of the things that we look for. So with that, I might pass it back to Vinny.
Thank you, Nick. Beautiful intro and a great warm-up into our two main presenters this evening. So now moving on to our second presenter, I'd like to welcome Andrew Lockhart of Metrics. Andrew has more than 30 years banking, funds management and financial markets expertise, specialising in leverage and acquisition finance as well as corporate and institutional lending. Andrew's considerable experience includes being responsible for the origination and portfolio risk management of large, diversified and complex loan portfolios, including corporate restructurings. Andrew holds a Bachelor of Business and an MBA from Queensland University of Technology. Can we all please welcome to the stage, Andrew.
Thanks everyone, and thanks to Stanford for the invitation to speak with you all time. For those that are not necessarily familiar with Metrics, a little bit of background to our business. We first launched our first fund back in June of 2013. We started with one Australian domestic institutional investor that invested $75 million in our first fund in June of 2013. At the time, it was myself and two of my business partners that ran Metrics, and so the three of us were running this first $75 million of capital. Today, almost 11 years later, we've grown that now to around 17 billion of assets under management. We employ around 150 people in our business. And the areas of activity for us are very much around competing with and working alongside the banks to provide access to capital and financing to a range of Australian companies. You'll see here that in this particular chart, we show the areas of activity for us, so lending to corporates, so publicly listed corporate entities or large private corporates. We're active in project and infrastructure finance. Commercial real estate is a significant part of our business. Around 60% of our business is focused on directly lending for commercial real estate purposes, and that's primarily focused on residential, large-scale residential, high-density dwellings and land subdivisions, and what we call leverage and acquisition finance. They're all parts of the loan market, but really what our role is to really originate transactions, so build long-term relationships with companies and companies management, seeking to understand their business, understand what drives the cash flow associated with the operations of their company, so that we can be very comfortable that when we lend money to that company, that they've got the capacity to service and repay their debt. And obviously, as a lender, you also want to make sure that you've got appropriate protections around their loan that you've provided. So, taking security, requiring the company to enter into covenants that are all designed to protect the interests of our capital and our investors. This chart here really just shows the growth of the business over the time since inception. We have a presence in Sydney, Melbourne, and in Auckland in New Zealand. We also have a presence in Brisbane and in Perth. So again, that role is to find the best opportunities to lend to appropriate companies and projects. This chart is really just showing you the kinds of companies and projects that we've been involved in financing. So the ASX publicly listed company level, companies like Woolworths, Origin Energy, Brickworks, Ramsay Healthcare, Metcash, Steadfast. These are all ASX publicly listed companies where we're providing debt financing to those companies. We're also involved in a range of project and infrastructure funding. So again, you can think of the West Connects project, the Sydney desalination plant, the Northwest Rail Link when it was built. These are all examples. In Victoria, the Victorian Cancer Centre, the Mornington Peninsula Motorway, examples of large-scale project and infrastructure debt financing where we've been a party to providing financing. You'll also see there a number of household brands like Arnott's and others that are well known in terms of companies that have been bought by private equity firms. So when a company is bought by private equity, they're looking for capital to be able to operate that business. So what is private debt? I guess the simplest way to sort of explain this to people is a loan is a confidential transaction between a lender and the borrower. The terms and conditions of that loan are not disclosed to the market, so people don't know the interest rate that we charge, the margin. They don't know the covenants, the security that's offered. We don't disclose the financial position of the companies that we lend to. Our role is to keep that information private and to provide financing to those companies based on our assessment of the risk. So unlike bonds or shares that might be bought and sold over a screen, loans tend to be made on the basis of core fundamentals of, we're lending money to this company or this project. We're comfortable that the purpose for which we're providing funding will be used to do what they're intending to do, and that we expect to receive our interest and fees and receive our principal on maturity. We don't trade it. We're not an active trader of debt. So we lend in very much the same way as a bank would lend. We're lending to good quality, large-scale, sophisticated companies. If you think about the market as a whole, what we've put here is really to show you that the vast bulk of debt in the Australian market is provided by the banks. So Australia doesn't have a deep corporate bond market of any size or scale. So companies aren't rushing off and issuing corporate bonds to raise debt financing. They tend to be unrated companies, so they don't have an external credit rating through the likes of an S&P or a Moody's. And so they're heavily reliant on the banks for debt financing. And so the kind of assets that we look to give investors exposure to through our funds are exactly the same types of companies that the banks provide financing to. Often we are lending alongside the banks on the same terms, same conditions, same pricing. So I guess the rationale and reason why this market has developed, if you go back to the time of the global financial crisis, 2007, 2008, we had a situation particularly for European and US-based banks where they got themselves into trouble. And as a result of that, a lot of private capital started coming into managers to buy the assets from the banks, buy these loan assets. What the regulator did as a result of the global financial crisis is they guaranteed deposits. So retail deposits were guaranteed, deposits are guaranteed up to a certain threshold. But beyond that, the government really introduced a whole series of regulations and policy to see the market fragment. And so, it's much more risk for the government if they're providing guarantees to banks so that the banks, if they go broke, their depositors are bailed out. But really, that's a lot of risk for the government to wear. And so regulation has been imposed, and that was really designed to limit and reduce the risk within banks. So if you think about banks, they're highly levered. You've got deposits, you've got senior debt, you've got subordinated debt, and a very small amount of equity capital. So shareholders' equity capital in a bank is quite small in comparison to the size of the assets, and their largest liability is the depositors. And so, of course, if you are then introducing regulation that says we want to de-risk the banks, we want an increasing equity component, what that means is it makes it harder for the banks to be able to generate a return. And so banks are motivated to lend money and to do business where they're generating a high return on equity for their shareholders. And as a result of that, if regulations change and they're required to hold more capital, their ability to generate the returns that shareholders expect is impacted. And so as a result of those two features, the fact that we don't have a bond market of any size or scale, we don't have options available to a lot of companies, and at the same time, you've had a pullback in terms of the willingness of the banks to lend to corporates. And that's what's created the opportunity for private credit in this market. So for investors, what's the purpose of this? I guess at the end of it, there are two things that we think are the drivers and rationale why people would consider private debt as part of their portfolio. Private debt can play two roles in an investor portfolio. At one end of the spectrum, it can be a very defensive asset class. The covenants, the controls, the security, the monitoring, the access to private information to assess and manage risk are designed to reduce the risk of volatility and designed to protect a lender's capital, so therefore investors' capital. So they are designed to provide protection around capital, but equally, it provides a very attractive source of income. So if we invest a lot in direct origination, which means we're dealing with companies directly, we charge those companies fees, we charge in margins, the underlying loan assets are all floating rate, and so as interest rates have risen, the total return that's been payable to an investor has increased. And so it's become a very attractive source of income. And so the two reasons why it's appealing from a defensive portfolio allocation decision, one, that stability, protection of capital through the appropriate lending that's undertaken, but also driving an attractive return that outperforms alternative asset classes. And so again, in Australia, there's a lot of protections that are also afforded under Australian corporate insolvency laws. So again, we operate in probably the most attractive legal jurisdiction globally in terms of the rights that a secured lender has compared to other markets. And when people think about this asset class, it's an asset class that people invest in that is primarily a domestic asset class. So if you invest in, say, private credit in offshore funds, you're likely to have an impact in terms of greater volatility through foreign currency issues. You'll have taxation issues, whereas investing in Australia is very similar to the return profile that you get from putting money on a deposit. You're getting interest and fee income through regular distributions of income. But again, what this chart shows is what the capital structure. So for those that are not as familiar with companies' capital structures, this chart really tries to explain what occurs in the event of a downturn. So people sort of said to me a year or two ago, what would be the situation for private credit in the event of a deterioration in economic or business conditions? Now, as a lender, when we assess the risk, we're not looking at the current position. We're looking and saying, okay, we're providing a loan for 3 or for 5 years. We need to think about what may happen from a business or economic perspective over the period of 3 to 5 years. And we want to make a conservative assumption around the performance of the company. And so what you're looking at here is a situation, say at the top of the cycle, equity markets are running hot, people are making money out of shares, there's lots of liquidity in the market, and then of course we go into a bit of a downturn. In a downturn environment, you're going to get a reduction in the earnings of the company, so shareholders' dividends are going to be reduced. The value of the company is going to be impacted. And so from an equity perspective, that's why you see a lot of downturn in equity prices and equity markets in a downturn. For a lender, what actually happens is the reverse. You get a situation where liquidity dries up, terms and conditions become more onerous. So as a lender, you're lending for on more conservative terms. And because of the reduced competition and liquidity, you're able to charge higher returns in terms of fees and margins. When borrowers want money in a downturn, they pay for it. And so what this really describes is the situation in terms of the capital structure and which asset class bears the risk of loss. Everyone's investing in equity with a view that the earnings of the company are going to continue to grow and you're going to make money from the increased value of the company. You invest in debt to get the benefit of equity as the risk that takes the risk of first loss. And so the valuation of the company can reduce. So in this case, say at the top of the cycle, the company is generating 10 million of earnings and it's trading on 10 times. At the bottom of the cycle, the valuation might be reduced to say 5 times and the earnings are down as well. But what that's trying to show you is that the asset class that's borne that risk of volatility and loss has been the shareholders. As a lender, I still expect to receive 100 cents in the dollar. So in terms of some of the things that the team at Stanford Brown and others look at when they consider the appointment or looking for a manager in the space, it's obviously a team that's credible, has strong track records, understand and have invested in origination capability, have invested in building relationships with borrowers, have a strong track record in terms of credit risk management, have the capability to work through different cycles. Often, and we always think as well, as our businesses become large and scalable, the underlying loan assets are very liquid. So as a business, we're running close on 17 billion. We have what we call a work in progress pipeline of anywhere between 8.5 to 10 billion at any point in time. We generally see about 2 to 2.5 billion of assets roll off every quarter. And so we're always recycling that capital. And one of the things that we do at Metrics is we try and contain investor risk by lending for shorter periods of time. So if you're lending for, say, a period of 2 or 3 years or 5 years, you've got a much lower credit risk, you've got reduced market risk, you've got increased opportunities to recycle the capital and charge fees. That becomes an important source of income for investors. But equally, as our funds have grown in size and scale, we've tried to pass the benefits through to our investors in the form of reduced fees and costs. So we have a range of different fund options. We operate 2 ASX listed funds. For Stanford Brown clients, you've got access to our unlisted funds. So one of the reasons people don't like the listed funds is the potential volatility of the trading price on the exchange. And so our role is to really say to people, does the Australian market make sense from an investor's perspective? And I definitely am of the view that the Australian market presents a very attractive proposition for investors investing in debt. Does the manager have the skill set to be able to originate, structure and manage risk? And then what are the ways in which you can then gain access to the market? So again, it's a private market, so it's not as easy as being able to buy and sell shares on the stock exchange. So investors need to think about how they gain access to the asset class. And that's around determining what is the return objective of the investor, what's the risk profile, and what is, as Nick said, importantly, what are the liquidity features of the fund if an investor wants to get access to their money quickly. But private debt, you'll see here, private debt really plays 2 roles in an investor portfolio. One, as I said, is that defensive part of the portfolio, and you'll see at the bottom of the fund, the chart here, to the left, funds like our diversified Australian senior loan fund, our secured private debt fund. Well-diversified portfolios where we've reduced the exposure to any one individual borrower to low levels. So again, one of the biggest risks that an investor is exposed to in private debt is the risk of a default in the event that the risk of a loss in the event that a borrower defaults. So importantly, one of the things that an investor needs to think about is you want to be invested in a portfolio that's well-diversified, where you've got limited exposure to any one individual company or project that you're financing. So, for instance, in MDIF, or the Wholesale Investments Trust, investors gain exposure to over 300 individual borrowers, where the average exposure to any one individual company is less than 0.5%. So, short-dated exposures, well-diversified, monthly income distribution, low fees, and I think it presents well as an option for investors. At the other end of the risk spectrum, I believe private credit can replace equities in a portfolio. And that's largely to do with the fact that you can generate high levels of income from private debt, not too dissimilar to the kinds of distributions that you would receive in the form of dividends, but a lower risk source of income. I've just put up here a couple of the details around our different funds, a couple of the ASX listed funds and MDIF. You know, the benefit again, that floating rate, as soon as the market's got a view that interest rates are going to rise or decline, it really reflects immediately in terms of the returns that are passed on to investors. So unlike bond funds that had duration risk, investors have lost capital because the rates have been fixed. The underlying loan assets in our portfolio are floating rate. And so as soon as those RBA rate decisions were made, it was immediately being reflected in higher total returns to investors. You'll see there, you know, again, the returns since inception and the target returns. Interestingly, what we've seen over the last couple of years is that position about banks withdrawing from the market, reduced competition, reduced liquidity, a tightening of terms and conditions, and a widening in credit spreads and fees. And that, again, has also delivered very attractive returns for investors, as you see here. So in terms of this particular diagram, you'll see there the 1 year spread to the RBA cash rate being 5.59% net. So add the RBA cash rate onto that and you're getting the total return that's being generated with that income distributed each month. And then we've got the ASX listed fund. I think one of the things that is important, and I'm probably way over time here, but I think one thing that is really important is, you know, in a private market, often people worry about the opaqueness, the lack of transparency. Obviously, the team at Stanford Brown have access to that and have been able to understand what we do. But importantly as well, for a broader market, because we operate listed funds, we're subject to a whole range of governance and oversight, independent oversight of our activities that are designed to give investors comfort around the quality of the underlying investments that are held in our funds and the way in which they are reflected in the unit price on the market. This particular fund appeals to those that want daily liquidity and more control over their capital than in an unlisted fund. And then we have the high yielding fund. This particular fund is really a hybrid fund, so it's a mix between high yielding debt and we also hold a number of equity positions in that fund. So again, designed to give investors a high income to replace equities, but we also look to, you know, invest in private companies where we might hold options or warrants or take in an equity stake in that company to give investors the opportunity to also profit from the performance of those companies. This is the piece of the marketing in terms of metrics and our capabilities. So obviously we've been doing it a long time. I spent about 26 years working for National Streaming. We've gone through lots of different cycles and over the last 11 years, every single one of the funds that we operate and manage has delivered in excess of the minimum target returns. And every single one of our funds will manage credit risk to ensure that our investors have not been adversely impacted as a result of any lending activity that we undertake. We've got a highly credible team and a lot of experience across the business, investment directors and others that have been in the business for a number of years, but also have extensive careers working in banks and investment banks and extensive relationships. We've been fortunate also as a business to win a number of awards. So we have the highest ratings from research groups like Zenith and Lonsec. I heard Nick mention Jana. Obviously, Jana is an institutional asset consultant. They also rate and review our funds. So there's a lot of independent oversight and research that goes into informing investors around our activities. And importantly, you know, I think the proof has been in the success that we've had around gaining investor support. You know, we now have over 30 corporate pension fund investors from Japan. We have got Northern European pension fund investors with us, Korean pension fund investors with us. So again, you know, global insurers, these are large institutions that have invested in our funds. And importantly, that capital has allowed us to support good quality Australian companies in terms of supporting their activities in the market. So with that, I'll stop and thank you very much for the opportunity to present to you today.
Thank you very much, Andrew. Excellent introduction to the world. There's no doubt there'll be a few questions at the end for you, delving a little bit deeper. And now I'd like us all to welcome to the stage Brett Jolly. Brett joined Macquarie's Asset Management Digital Infrastructure team in June 2020, having previously worked for 11 years across investment banking and 4 years in corporate taxation. Since joining Macquarie, Brett has been involved across a range of execution, a number of deals, including the $4.6 billion Australian acquisition of independent fibre provider Focus Group, $1.6 billion New Zealand acquisition and merger of 2 Degrees and Orcom Group to create a leading integrated telecommunications company in New Zealand, and the Australian $3.6 billion divestment of Axicom. Brett is currently on the board of 2 Degrees and was previously director of the New South Wales Land Registry Services and an alternative director of Axicom. Brett holds a Bachelor of Laws and Honours and a Bachelor of Commerce Accounting from the University of Adelaide, and to round it all off, he's a qualified chartered accountant. Thank you very much for joining us at late notice to sub in, and the show goes on. Please, everybody, give an extra special appreciation to Brett.
Thank you very much for having me, and thanks for that lengthy introduction. So my name is Brett, as just been mentioned. So I'm a managing director in our infrastructure business here at Macquarie, and I'm just going to spend a few minutes probably talking slightly differently, maybe what you're used to. I want to try to bring to life some of the things we do, some of the investments we make, and some of the characteristics as to why we like them. So hopefully it's interesting. We'll see how we go. So before I get going, I might just spend a minute about talking about Macquarie Asset Management in particular. So you're probably all familiar with Macquarie more broadly, obviously on the banking side, but for those who might be less familiar with asset management within Macquarie and infrastructure in particular, we're the largest infrastructure manager globally. So we've got about over 160 assets throughout the world and offices in all of the key markets. So we're very strong in Europe, UK in particular. We've got offices in New York as well, and then all throughout Asia, and obviously in Australia as well. So within Australia, we've got about 16 assets of nearly $30 billion of assets under management, managed by about 20 direct professionals, including myself and a broader team, obviously. What does that mean? I think the benefit of that is we really get the ability to share understanding and knowledge of what's happening across a range of different asset classes, and some of the trends that we see either in Australia or globally. We're able to share that throughout the network and bring that to life for able to source opportunities, but then bring it all to life and access those opportunities for ultimately our investors. From the way we think about our business here in Sydney in particular is that our job is trying to find those opportunities, because each of them has a different, risk and return profile, and then match them most appropriately to the source of capital. Through the MPIF fund, which some of you may be familiar with, what we're trying to do there is unlock those infrastructure opportunities on a wholesale basis, because they can be more difficult to access, given that they are typically quite large and therefore more suitable for larger either pension funds or super funds who have obviously been taking them private, particularly off the stock markets throughout the world. So traditionally, probably going back 10, 15, 20 years, you may be investing them on the stock market. So obviously Sydney Airport was recently taken private by another manager, but there's not too many left now. Maybe I can say Transurban and a couple of others, at least in Australia, for wholesale and retail investors to be actually able to invest in. So what we try to do is find those opportunities and then make them available to various funds that we have throughout our portfolio. So if I spend a couple of minutes just then talking about what the characteristics of infrastructure are and what the benefits are, there might be some similarities to some of the topics and areas that Andrew just mentioned as well. So what we're looking for in infrastructure assets are things like, are they essential services to the community? And the reason we look for those is because then that adds to the defensive qualities of the asset, and therefore when you're thinking about your portfolio construction, is going to play a lower risk component in your portfolio. That necessarily means the return won't be as high as maybe a more speculative investment. But similar to some of the themes that Andrew was talking about, it's very much designed to play that more foundational role in your portfolio. So essential services then means that they're unlikely to be disrupted over time. So think about, water utilities, electricity utilities, airports, toll roads, and we'll talk about a few others on a couple of slides upcoming. But really, the defensive nature is what that essential services is trying to get at. High barriers to entry, similarly, the more strength the competitive position, or the more difficulty it is for people to come into that market, then, again, the more defensive it is. Long life assets, so all the assets we're trying to invest in are for the very long term, so 15, 20 years plus. So things like airports obviously have had an up and down time over the last 3 years through COVID. But if you think about it now, if you're taking a long-term view, it doesn't matter so much provided you've managed your capital structure properly if there's a couple of years of weakness, because as long as the underlying thematic is there, then it sort of writes itself over time. Low demand elasticity, again, that goes to the defensive nature of it. And then the final thing which is important, and again, similar to some of the elements of what Andrew was talking about, is really the stability and predictability of the cash flows, but the fact that they have the ability to grow over time, both through inflation linkage, but as well just underlying structural trends, whether that's population growth, GDP growth, or other demand trends, which we can touch on in terms of a couple of asset classes. So what does that all mean in terms of those characteristics? Well, the benefit that infrastructure plays is really as part of your equity component of your portfolio, but it'll be balancing a lower risk position with an appropriate return profile. So really within infrastructure, we think about quite low risk assets, almost like bond-like to some degree, where you're in the sort of mid to high single digit returns, all the way up into the mid-teen style returns, where you're blending some of those categories and potentially taking slightly higher risk on either the competitive position or the growth drivers to match those where you might be looking for a slightly higher return. Portfolio diversification, as I mentioned before, infrastructure assets are reasonably difficult to come by, and really that's a structure of the market, being the size and scale of capital required to own and grow these assets. So that's a benefit of being able to access funds there. Liability matching, again, with those growth drivers and CPI linkage in particular, what that means is for super funds and pension funds, say out of Canada, they're really matching the liabilities for their members to those cash flows as they need them and as they retire. So again, infrastructure plays that important long-term role, not just in terms of the outlook for the business, but in terms of the cash flow that it delivers for the owners and ultimately the members of the funds that are invested in them over time. Inflation hedge I've just mentioned. And then the other benefit of infrastructure assets as opposed to high growth assets is the yield is very similar to, again, bond or some sort of debt-like instrument. So again, a lower return, but typically you'd be looking at sort of 4 or 5% style yields within those investments. So the benefit really, in my mind, of infrastructure really is it can play a very important part of people's portfolios and balance off other areas that people might be looking at in terms of them providing more high growth, high returning assets, but also play that foundational element as well. So I've already mentioned a couple, but in terms of some examples of infrastructure, look, the definition of infrastructure continues to evolve, and you'll be familiar with most of these types of assets. I'm going to touch on a couple that were just mentioned in my bio in a segment, but you can obviously see from the page that there's a broad spectrum of these assets, and each of them have a different association with those characteristics that I just mentioned. So it's not like you tick the box on each of those characteristics and right, it's definitely infrastructure. What you look at is just blending them across them all. So an airport, for example, would have very different drivers than, say, a port, and a toll road, different again. And so what our job, frankly, is to try and understand the business model as best we can, and then really understand the risk that is inherent in their business model, and then match the return within that. And sometimes things change. So obviously COVID happened right when I joined Macquarie, and that probably changed people's perception of what the risk was in an airport, because before that, sure, there was pandemics and so forth, but they didn't have the impact that they did within COVID. So that saw a re-rating, I guess, of the risk and the return profile that's inherent with an airport. But generally speaking, what we're looking for is those things that provide that really defensive, those defensive qualities and those defensive characteristics. So most of you will use most of these services every single day, whether it's electricity distribution or accommodation, education, healthcare, things like that. So they're things, as I said, going back to the first principle or the first characteristics that are essential. And I think that's what Macquarie is really focused on, is working out how it can partner with not only the funds that support us to buy these assets, but one of the things that we get most excited about is how do we work with government and other parties to help grow them and improve them. And I'll touch on that a little bit in a second with a couple of our case studies. Couple of charts. So I think the main thing to draw out from these charts is coming back to then the performance of infrastructure and the relationship to interest rates and inflation. So what you can see is on the left chart, basically the return in infrastructure is more favourable when there's higher inflation. And the reason for that is because, generally speaking, there's either pricing power or there's ability to pass through inflation. So the yield and then the growth or the cash flows are increasing, and therefore the value of the business is, generally speaking, increasing at the same time. So again, that linkage to cost of living and cost inflation pressures, we've seen probably 2020, 2021, really low inflation and really low interest rates. And then obviously, as everyone would know, it really took off in sort of late 2021, 2022, 2023. And whilst that's a difficult thing for the economy and more broadly, the cash flows in these assets really start to grow quite strongly when they're linked directly to inflation of 7, 8, 9%, depending on which market you're talking about. That really provides, I guess, a hedge as well, if you like, for people who are invested in those assets. So that's, I guess, the mathematical relationship, if you like, to ultimately interest rates and inflation. So I'm going to spend a couple of seconds now, if it's okay, just talking about a couple of case studies on assets we've bought. Maybe just unpack those for why we like them and what we're trying to do with them and how they tie back to infrastructure. So the first one is Focus Group. I'm not sure if people are familiar with this, but this is one of the assets we bought in during COVID. We purchased it in 2021. And for those who may not be familiar with it, basically what Focus does is it builds a fibre network. So it's an amalgamation of various companies over 10 or 15 years prior. But in its current form, basically what it owns is a national network of fibre. And so if you look out on your street, you'll see lids that have NBN or Telstra or Optus or Vocus. And so what's running through those and underneath those lids are really thin cables which really transport the data that we all use on our computers and servers and so forth, or are taken off mobile phone towers from your mobile phones and send it either to data centres or to other locations throughout the world. And so why did we like that? Well, I think it may be obvious, but obviously the use of data and the growth in use of data is really a fundamental thing that is essential to the economy, not only now, but from our perspective going forward as well. And so we really liked that broader thematic. And what we were doing was spending a lot of time working out where should we be investing and where should we be gaining exposure to that. And so we, going back to the global network, spent a lot of time with our European colleagues and American colleagues looking at what they had purchased and what they'd invested in those markets as well, and ultimately landed on Vocus. And the reason for that was, number one, the characteristics of not only those essential services, but also the fact that it had pretty good infrastructure characteristics. So solid medium-term contracts, good cash flow generation, and importantly, we had a lot of opportunities to deploy further capital into it to help continue to grow the network, because obviously everyone would familiar with Telstra and NBN, but from our perspective, there was a great opportunity to invest in new markets and new areas, given the focus was much smaller than those respective organisations. And we thought there are areas where there was an opportunity to deploy more capital into certain parts of Australia. So again, back to that desire to help community need and growth in digital services. So we liked that element of it, and there was the benefit of this asset is we thought it had a nice balance between those characteristics and the return we thought we'll be able to generate in it. So this is probably more in that mid-teen style return, so slightly higher than maybe some of the more core defensive assets like a toll road or a utility. But again, balancing those infrastructure characteristics against the return is ultimately the judgment that we need to make. So if I move to the next slide, what you can see here is a very stylized chart of the network on the right-hand side. And you can see here that whilst you might imagine that the fibre networks are very metro-based, or telecommunication networks are very metro-based, you actually need to be able to send the data all around Australia, and Vocus has the second largest network behind Telstra in that respect. And you can see some of the numbered areas of growth that we've already invested in and will continue to invest in. So again, a real nice opportunity to acquire something that has good characteristics but to continue to grow it as well. The other business then that Vocus owned, it also owned a business in New Zealand called Orcon. And following on from this acquisition, we then acquired another business called 2 Degrees. I don't know if anyone's from New Zealand or familiar with New Zealand, but 2 Degrees is probably one of the biggest brands in New Zealand, outside of maybe Air New Zealand and a couple of others. And so through the investment that Vocus had in New Zealand, we managed to do a deal with some American investors who had done a great job of growing 2 Degrees, but it was ready for the next phase of capital and investment. And so the reason we liked 2 Degrees was hidden within 2 Degrees, whilst you might think it's a mobile retailer, were 1,200 mobile phone towers and mobile phone sites. And so we owned Axicom, which is an Australian-based tower company. But those tower sites really underpinned a really strong infrastructure base that was otherwise hidden within a retail brand, for lack of a better word, with 200 or so shops throughout New Zealand selling mobile phones and SIM cards. And so whilst a retail business is not one we would typically, or we wouldn't invest in because it's not infrastructure in the same way as we define it, there was fundamental value sitting to be unlocked in that business. And pleasingly, shortly after we bought that one, we were able to sell those towers for a material uplift on what we bought the overall business for. And so whilst that's not a typical strategy we do employ, we do like to work out partly how do we find good infrastructure assets, but also obviously how do we maximise the value available from the investments we can identify. And really that was only going to able to be unlocked because one, we had the capital, but two, we bought Vocus. And so whilst it wasn't a core part of the thesis for our initial investment in Vocus, we were able to extract it, which provided a nice upside for the fund and the investors in both businesses. So, and the fund that's invested is something that NPIF is invested in as well. So we're currently sitting on about 45% return on 2 Degrees and sort of about 17, 18 on Vocus. So look, touch wood, things are going okay, but you never know. But from our perspective, we're really pleased on how both of these investments are going. So that was all I wanted to cover, because I could tell you more about NPIF in the year and all that, but I think from our perspective, I just wanted to unravel, I guess, a little bit of how we think about infrastructure, and then obviously we're happy to take any questions at the end as well.
Thank you very much, Brett. When you stay on the stage, I'll ask Andrew if you can come over and join us, and Nick as well, if you can, please. And we'll grab a couple of questions from the floor. Anybody wants to get started? Got a couple of roving lights. Perhaps while we do that, I might ask you, Andrew, is it possible you could talk us through the typical sort of deal that you might do with Metrics? Just one example of that, obviously breaching any confidentiality, but the type of capital party, size of the deal, terms. It can be pretty cool. Get your lapel and switch on there.
It's a pretty good market for the cover. I'd say in real estate, as an example, you go out to near the Westmead Public Hospital, you'll see a number of very large, high-rise residential towers. We're funding and constructing a number of high-rise residential towers at Castle Hill. We're doing a 1,200 lot land subdivision at Penrith at the moment. So these are large-scale residential development projects where the consumers are buying houses or land for future housing, or they're buying apartments for future development. And those transaction sizes are hundreds of millions of dollars. So these are not small transactions.
And I guess the range of sort of return that you'd hope to get on that, and the protections that you built in for yourselves.
It's such a wide range. Our role, as I said before, is to originate transactions and to understand what is the risk associated with those transactions and price them. So at one end of the spectrum, you can have a very strong, high investment grade, publicly listed corporate like Woolworths, might be charged a margin of 1.5%. At the other end of the spectrum, you might be providing mezzanine debt into a property development transaction where you're generating 20%. That's why, from an investor's perspective, what we've tried to do is to say the investments in, say, a Woolworths is more of the defensive part of your allocation. If you're looking for higher yielding mezzanine, you're really talking about an equity market replacement through debt. And so our funds are designed to give investors a choice. Some investors want higher returning, higher yielding investments, and we have that option. But the core of what we think private credit is about is delivering stability, delivering a defensive asset class, delivering a predictable income from a diversified portfolio of direct loans. So the asset class is very, very broad, very flexible, and our role is to make sure if we're lending for mezzanine transactions, we monitor and manage the risk just as we would with a high investment grade transaction. It still gets the same level of oversight from us in terms of the way we do it, but we recognise that there are different risk tolerances that our investors have, and that's why we segregate the assets into different funds.
Perfect, that's excellent. And perhaps one question for you, Brett. You stepped us through there a few examples of the things that you look for in infrastructure, and you did call out it's a very broad universe. It's a very fluid definition of what fits into infrastructure and doesn't. Could you give us an example in the room of some things, some types of assets that others may define as infrastructure and consider in their investable universe that you just don't think are attractive and that wouldn't form part of your portfolios?
Yeah, look, I think from my perspective, I wouldn't say there's good businesses in every industry, but I think it's got to balance the risk versus the return. So an area we haven't spent as much time in and invested in is probably healthcare, for example. So other managers have probably spent a bit more time looking at that and investing in some healthcare assets. So we've been doing a bit of work over the last few years on that. But that's probably one where, again, depending on the return and the defensive qualities, there's a judgment to make. Where should that sit in someone's portfolio, and is it in that mid-teens, or should it be slightly higher because it's been one of the private equity players have invested in as well? So that's probably an obvious one that would jump out at me. And I think with the move to digital infrastructure, so if you look at focus to a degree, we would class them as digital infrastructure, obviously related to the digital economy, about data and bandwidth and those sorts of things. There's probably a temptation for people to put things that are sort of technology or proximate to digital infrastructure and try and wrap them up as digital. So software companies or anything that sort of has some level of recurring business model, you have bankers running around saying you should buy this and pay a high price for it. So the market hasn't quite moved there yet. It might move there, but I think people are working through the thinking still on just how stable and long-term those trends are, because it obviously is changing quite rapidly, especially with some of the things that Google and Amazon and other people are doing. So we do spend a lot of time in that space looking at it, but that's probably one that is probably an evolving opportunity one way or another, depending on the value and the access to capital.
Perfect. Thank you. I think data centers is one of the things. We see managers come through our doors from a variety of different, represent a variety of different asset classes, and data centers seem to fit it into many, many people's portfolios. I'm getting a few signals from the back of the room, but we'll probably have got time for one more question if we have one. I think you've thoroughly answered them all. So let me just say thank you very much to everyone for coming out this evening. It's a beautiful, warm evening here in Sydney, so thank you for coming and spending an hour or two of it with us. We'll leave you to your evening. Please enjoy it, and thank you again for your support at Stanford Brown. We never take it for granted. Thank you.